Your market news now. The JSE is little changed with its global peers mixed as investors await for the release of the U.S. Federal Reserve's minutes from its recent meeting. Investors are betting that the Fed is now at its peak in terms of rates for the cycle. Oil prices climbed more than 2% as further supply cuts in the OPEC Plus production are expected to be announced. Meanwhile, Sibanye-Stillwater's market value slumped more than 23% after the mining company said it will issue $500 million in convertible bonds to fund its recent acquisition of US-based metals recycler Reldan and provide working capital. The notes will be issued on November 28th, subject to shareholder approval. To give us more perspective on the markets, we are joined by Han Tan, who's the Chief Market Analyst at Xfinity. Han, thank you so much for your time. Let's talk about global market sentiment right now as we await those FOMC minutes.
Yeah, so there's a bit of a cautious approach here given this risk-on activities that have happened in recent weeks. And there's been an everything rally, right, from stocks to treasuries. And so markets are still on the lookout for perhaps reasons to push stocks higher, be it out of NVIDIA's earnings later today or, as you said, the Fed meeting minutes.
Let's look at a review of the market landscape since the Fed hiked rates in July.
Yeah, so it's been a roller coaster ride, really, and all you got to do is just compare the charts between the US dollar index and the S&P 500, and they'll pretty much tell you everything. So since July, the dollar soared and stocks tumbled as markets had to really struggle to come to terms with this higher for longer mantra that the Fed said it would have. But then this month, things took an about turn as markets now warm back up to the idea of Fed rate cuts, right? So arguably, I think safe to say, the primary driver for markets really for most of this year has been this shifting expectations surrounding what the Fed will do with its benchmark rates.
Speaking of these rate cuts, are you buying into them or you think the market's a little ahead of itself?
Yeah, look, if you look at the economic data, there is reason to believe that these rate cuts, at least what's predicted right now, at least has more legs now compared to where we were at the middle of this year, right? Because recall at the the middle of 2023, markets expected that first rate cut to happen by this past September, right? But obviously that didn't happen. The resilience of the US economy has really caught everyone pretty much by surprise, even the Fed themselves. So I think it remains to be seen really if those expected Fed rate cuts, the first one perhaps happening in May of next year, whether that would actually pan out this time around.
How real is the risk of disinflation?
Disinflation, yes, and we have been seeing that really for these past few months here. Now it's a case of making sure that an inflation resurgence doesn't actually happen. There are risks to that, but policymakers, not just the Fed, but central bankers around the Western world, really hope that inflation can come down given how aggressive they have been with their rate hikes really since 2022.
When you look at moves in bond market activity right now, what do you believe to be the underlying tensions that still are within the bond market or rather at play?
Yeah, great question. So, on one hand, you do have this narrative about these potential Fed rate cuts happening perhaps next year. And so that's really eased some of these treasury yields, right? Having said that, I think markets are also aware that there's bound to be more incoming supply out of US treasuries because of the greater financing need that the US government has in the years to come, right? So that should offer a supportive element for treasury yields, and that should translate into a tougher road ahead for stocks. But really right now it's just a readjustment and a recovery for both stocks and bonds as they try and pencil in some of these rate cuts for next year.
How much is the recession word coming up in conversations with investors right now?
Plenty, suffice to say. Look, because it does form the basis for the narrative, again, for those Fed rate cuts for 2024, right? The idea is that all these rate hikes that we've seen, over 500 basis points since last year, that's bound to take a toll on the US economy, right? Granted, it's happened perhaps slower than expected, and also to your point, markets may have read a little bit too much into the recent jobs and inflation data, but the signs are there, right? So the idea is that if this persists and the US economy continues faltering under the weight of these rate hikes, then the Fed eventually has to then pivot, especially if there's a recession in the US economy.
And I was going to ask you on that pivot, do you believe that those cuts will be coming about as a result of a recession or as a result of inflation getting to where it needs to be?
Yeah. As things stand right now, it's more of an extension of the recession, right? Because even with the declines in the CPI, the disinflation that you mentioned earlier, core, for example, is still about 2 times above the Fed's inflation target, right, of 2%. So I think it's more of if there's a recession, I think the Fed will use that as a cue to perhaps not just feed into the disinflationary pressures, but then also signal an easier policy stance, keeping in mind that they have plenty of bandwidth to lower interest rates, given how high they've already sent them.
Han, let's leave it there. Thank you so much for your time. That is Han Tan, who's the Chief Market Analyst at Xfinity. Looking at markets right now, as I mentioned, the JSE little unchanged. Most of its peers are mixed, with European markets holding near 5.5-week highs. After the break, we'll have a conversation with the CEO of Telkom. So stay tuned.